Imagine waking up one morning in 2026 and feeling like the US economy just got hit by a punch you never saw coming. Not because a factory collapsed, not because a bank failed overnight, but because a negotiation table thousands of miles away quietly changed the price of everything you touch. Gasoline, groceries, airline tickets, shipping costs, rent pressures, interest rates, even the mood on Wall Street. And here's the part most people miss. The hit can land whether the talks with Iran succeed or fail. The shock isn't only about conflict. It's about uncertainty, about risk premiums, and about how fast markets reprice the future when they smell a turning point. We're going to talk about the economic blow that could shake the United States as negotiations with Iran intensify. And we're going to do it in a way that makes you see the wiring behind the headlines, not just the headlines themselves. Because in 2026, the biggest trap is believing that geopolitics is over there, while the consequences show up in your monthly budget right here. At the end of this, I'm going to give you one core idea you can use like a compass. A simple way to think about why the same event can make some people richer, make others poorer, and still leave almost everyone feeling more anxious. But first, we need to start with the uncomfortable reality that markets are not reacting to what is happening. They're reacting to what could happen next and how likely it is. That's why oil can drop sharply on a single hint of de-escalation, even before any agreement is signed, because traders price probabilities, not certainties. That's exactly what we've seen recently. Oil prices moving on signals tied to US-Iran talks and broader regional risk, with traders watching every phrase and every rumor for what it implies about supply, shipping, and escalation risk. If you want the simplest picture of why this matters to the US economy, it's this. Energy is still one of the fastest ways to transmit a geopolitical shock into inflation expectations, consumer sentiment, and central bank decisions. You can argue all day about whether the US is less sensitive to oil than in the 1970s, and it is in some ways, but oil remains a psychological price and a logistical price at the same time. It sits inside transportation, inside plastics, inside food supply chains, inside manufacturing inputs, and inside the expectations people carry when they decide whether to spend or save. The Federal Reserve itself has studied how oil shocks feed into US inflation and output. And even when the pass-through is not one-to-one, it's meaningful enough to change trajectories at the margin, especially when the economy is already balancing on a knife edge between cooling inflation and avoiding recession. Now, when people hear Iran negotiations, they often jump straight to one storyline. If a deal happens, oil gets cheaper. If it fails, oil gets more expensive. That's the surface-level version. The deeper version is about volatility, credibility, and the second-order effects that land with a lag. The negotiation itself is a volatility machine because it changes the probability distribution of outcomes. A credible path to de-escalation can lower the geopolitical risk premium in oil. A credible path to sanctions relief, depending on the structure and enforcement, can shift expected supply. But a fragile process that could collapse in a week can do something worse than a stable confrontation. It can create whiplash. Businesses hate whiplash because it turns planning into guessing. And in 2026, planning is already fragile due to global supply chains that still have scars, due to interest rates that remain high by recent historical standards, and due to a consumer that feels squeezed even when the top-line data looks fine. So let's talk about the three channels through which a negotiation with Iran can shake the US economy, even before a single policy change becomes official. First channel, the oil channel. Prices, risk premiums, and shipping choke points. Iran is not just another oil producer. It sits near one of the world's most sensitive energy arteries, the Strait of Hormuz. Even the possibility of disruption there can move markets because a large share of globally traded oil passes through that route, and traders price the tail risk of disruption, not the average day. Institutions that track conflict scenarios in the region explicitly discuss the risk of obstruction or threats to shipping in Hormuz as a deterrence tool in a crisis environment. And when the IMF speaks about oil export disruptions from Iran or broader regional flow risks, the message is simple. It tends to push oil prices higher, especially in adverse scenarios involving the region's transit routes. What does that do to the US? It can do two things that seem contradictory, but can both be true. It can lift measured inflation through gasoline and energy components, and it can also slow growth by squeezing real disposable income. That's a nasty combo because it pressures the Federal Reserve in both directions. Inflation says, stay tight, growth says, ease. When the Fed is forced into that dilemma, markets become hypersensitive, and the cost of capital can jump around in a way that hits housing, autos, small business credit, and investment. You don't need a war to get that effect. You just need uncertainty high enough that the market starts buying insurance in the form of higher risk premiums on oil, on shipping, on credit spreads, and on volatility itself. Second channel, the sanctions and trade channel. What changes in restrictions could mean for prices, supply chains, and corporate behavior. Iran negotiations almost always revolve around sanctions in one form or another, because sanctions are the lever and the bargaining chip. And the US has continued to use sanctions tools to target revenue streams and networks tied to Iranian petroleum trade and broader pressure goals. So the market question becomes, will enforcement tighten? Will it loosen? Or will we get a confusing mixture of public messaging and private enforcement that makes compliance departments panic? Here's why that matters. Uncertainty about sanctions compliance can freeze legitimate trade, raise transaction costs, and push more activity into higher cost channels. Even if the US doesn't change a sanction overnight, the perceived direction of policy affects how banks, insurers, shipping firms, and commodity traders behave today. When compliance risk rises, the cost of doing business rises, and those costs are passed along. When compliance risk falls credibly, some of those costs can unwind, but only if firms trust that the policy path will stick long enough to justify reopening channels. In practice, companies don't bet their reputations on a fragile détente. They bet on clarity. Third channel, the confidence and financial conditions channel, the mood, the markets, and the reflexive loop. This is the channel that turns geopolitics into real economy damage, even when nothing physical breaks. If markets believe the Middle East risk premium is rising, equity valuations can re-rate, investors can rush into safe havens, and the dollar can strengthen in risk-off episodes. A stronger dollar can help on imported inflation in the short run, but it can also hurt US exporters and tighten global financial conditions, which feeds back into US growth through trade and financial linkages. Meanwhile, if energy prices pop, consumer confidence can fall fast because people feel energy inflation immediately. And when confidence falls, discretionary spending slows, and that hits everything from retail to travel to housing demand. Now, let's connect this to the central tension of 2026. The US economy is not operating in a vacuum. It's trying to land the plane after an inflation fight. That means the Fed is hypersensitive to inflation expectations, and markets are hypersensitive to the Fed. So an oil-driven inflation pulse, especially one that looks persistent rather than a one-week spike, can delay rate cuts, keep borrowing costs elevated, and tighten financial conditions even if growth is slowing. This is not theory. The Fed's research on oil shocks emphasizes how commodity shocks can feed into inflation and output in models designed to capture global interactions. So what does the negotiation with Iran do? Specifically, that could feel like a blow to the US economy. It creates a fork in the road where both paths carry risk, just different kinds. Path 1, negotiations deteriorate and risk of escalation rises. In this path, the risk premium in oil rises, shipping insurance costs rise, and businesses start building extra buffers, extra inventory, extra hedging, extra caution. That caution slows the economy. Meanwhile, energy prices push inflation up at the same time. That's the classic stagflation anxiety. Not necessarily 1970s style across the entire structure, but a modern version where essentials rise faster, and the average household feels poorer, even if wages rise nominally. And the Fed's job gets harder. It can't celebrate falling inflation if energy is pushing the needle back up. You may hear commentators say, but US oil production is high. The US is a producer. True, but that doesn't immunize the US consumer. Gasoline prices are still linked to global crude pricing, refinery constraints, seasonal blends, and distribution. And even if energy producers benefit, most households and most non-energy businesses experience energy price spikes as a tax. It's a transfer from consumers to producers, and in the short run, it tends to reduce the broad consumer spending that powers the economy. That's why energy shocks are so politically and economically sensitive. They are immediate, visible, and emotionally loud. Path 2. Negotiations progress and de-escalation becomes more credible. This path sounds like the good one, and in many ways it can be. Oil can fall on reduced risk premiums, and that can ease inflation pressure. We've seen markets react positively when signals suggest de-escalation and negotiations becoming more serious, with crude prices dropping on the idea that risk could be reduced. But here's the twist. Even a good path can shock the economy if it changes expectations quickly. If oil drops fast, it can cool inflation faster than anticipated, which might encourage faster rate cuts, good for borrowers. But it can also stress parts of the energy sector that planned investment around higher price assumptions. It can shift capital flows, compress energy profits, and reprice credit risk for firms tied to shale, services, and energy-linked regions. That doesn't mean the US economy loses overall, but it does mean winners and losers rotate quickly, and fast rotations create financial turbulence. Also, de-escalation can come with its own uncertainty. What does the US give? What does Iran give? How enforceable is it? And how stable is it domestically on both sides? If markets suspect a deal is politically fragile, volatility can remain high even as prices fall because traders keep buying protection against reversal. That's not cheap. Volatility is a cost, and that cost gets embedded in financing and in business planning. Now let's bring it closer to your day-to-day life because the blow is not an abstract chart. It's how a negotiation changes the prices you pay and the opportunities you have. If oil spikes, the first obvious impact is at the pump, but the second impact is freight. Freight costs touch food, retail goods, construction materials, and e-commerce logistics. Then comes air travel, because jet fuel and demand expectations influence ticket pricing. Then comes inflation expectations. If households believe prices are rising again, they demand higher wages. Businesses raise prices preemptively, and the inflation psychology reawakens. That psychological component is why policymakers fear energy shocks even when they are temporary, because temporary becomes sticky when people act like it's permanent. The housing market feels it too, not because oil directly sets mortgage rates, but because mortgage rates are a financial condition story, and financial conditions are a Fed expectation story. If energy inflation complicates the Fed's path, mortgage rates can remain elevated longer than expected. And that does two things simultaneously. It locks in existing homeowners who don't want to give up low-rate mortgages, and it blocks new buyers with affordability constraints. That creates a shortage of listings and a frustrated buyer pool, an environment where prices don't fall as much as people expect, even when affordability is poor. In 2026, that kind of housing tension can become political again, and when politics enters housing, policy risk rises. Another uncertainty premium. Small businesses get hit through credit. A restaurant owner doesn't care about geopolitical risk premiums as a concept. They care that their line of credit got more expensive, their deliveries cost more, and their customers are spending less. And the most dangerous part is timing. These effects land with a lag. A spike in oil today can show up in consumer behavior over weeks and months. A shift in Fed expectations today can change refinancing conditions and hiring decisions over months. People often look for the crash to happen immediately, but economies rarely break like glass. They fray like rope. So the real question is, why does Iran negotiation matter so much right now, in early 2026? Because the global energy market is balancing on multiple moving pieces. OPEC plus production decisions, seasonally weak demand periods, geopolitical risks, and the market's perception of supply tightness. Reuters reporting shows how quickly oil markets are reacting to Iran talk signals and to OPEC plus output decisions at the same time, which tells you the market is not calm. It's on alert. In a calm market, one headline doesn't move prices hard. In an alert market, a headline is a spark in dry grass. Now let's talk about a scenario that many people ignore. The negotiation itself becomes a bargaining cycle where threats, partial steps, and reversals are used as leverage. This creates a stop-start pattern, which is poison for macro stability. In a stop-start world, businesses hesitate to invest, households hesitate to make big purchases, and lenders become stricter. That strictness shows up as tighter credit standards. And tight credit standards can slow the economy even if the Fed doesn't raise rates, because the effective cost of money rises when banks say no more often. This is why geopolitical tension can behave like a shadow rate hike. It tightens financial conditions without the Fed touching a lever. And if the Fed is already fighting inflation, it can't easily offset that tightening with easier policy without risking inflation credibility. So the economy can get squeezed from both sides, higher costs and tighter credit. Now, I want you to hold a single image in your mind. A rubber band pulled tight. The US economy in 2026 can feel like that rubber band. On one side, you have cooling inflation impulses in some categories, and on the other side, you have sticky essentials and policy uncertainty. When a new shock arrives, like a Middle East risk flare, or even a chaotic negotiation headline cycle, the rubber band can snap back violently. Not necessarily into a depression, but into a period of sudden repricing. Markets swing, hiring slows, consumer confidence drops, and policymakers look like they're reacting rather than leading. And here's the most dangerous part. Politicians and commentators will try to sell you a single cause story. They will say, it's just corporate greed, or it's just sanctions, or it's just Iran, or it's just the Fed. Real economic shocks are usually multi-causal. Negotiations with Iran can be the trigger, but the vulnerability is already there. High sensitivity to financial conditions, high public anxiety about prices, and a global system where shipping routes and risk premiums matter. So what would a blow that shakes the US economy look like in practical terms? It would look like a sequence of events rather than one event. First, headline risk rises. Markets start pricing a higher chance of disruption. Second, oil jumps, not necessarily to extreme levels, but enough to change inflation prints and sentiment. Third, bond yields react as investors adjust their view of Fed policy, either expecting higher for longer if inflation rises, or expecting recession risk if growth weakens. Fourth, stocks wobble because uncertainty premiums rise. Fifth, corporate behavior changes. CFOs delay hiring, delay expansion, reduce risk. Sixth, households feel it. Gasoline up, groceries up, credit tight, anxiety up. Seventh, political pressure intensifies, and policy responses become more reactive, which can further increase uncertainty. That's how a negotiation becomes an economic tremor. On the other side, if talks progress and oil drops sharply, a different but still powerful sequence can happen. Inflation prints cool quickly, markets start betting on faster rate cuts, risk-on rallies appear, but sector rotations become violent, and any hint of reversal snaps the market back. Volatility becomes the story, and volatility itself is an economic cost. It affects pension funds, corporate hedging, the cost of capital, and the willingness to invest. This is why serious outlets are emphasizing not only the talks, but also the broader tension context and the potential for miscalculation, even while mediators push for de-escalation. And it's why energy analysts and policy research centers are mapping multiple conflict scenarios and their implications for oil infrastructure and transit routes. Now, I promised you a compass idea. Something you can use to make sense of why this can feel so destabilizing even if nothing catastrophic happens. Here it is. The modern economy is increasingly driven by expectations layered on top of leverage. Expectations determine pricing. Leverage determines fragility. When expectations shift quickly, because negotiations change the odds, leverage systems react non-linearly. That's why small changes can have big effects. A modest oil move can create a big sentiment move. A small shift in rate expectations can freeze a mortgage market. A few weeks of volatility can alter hiring plans for a quarter. If you understand that, you stop asking, did the negotiation succeed? And you start asking, did the negotiation change the probability distribution, the credibility, and the volatility? Because that's what moves the real economy. So what should an ordinary person do with this insight in 2026? Not panic, not pretend you can predict geopolitics, and not fall for the simple stories. Instead, watch the leading indicators that translate geopolitics into your life. Oil prices, gasoline trends, shipping disruptions, inflation expectations, and the Fed's tone. Understand that risk premiums can fall fast and rise faster, and treat your personal finances and career planning with the same logic. Reduce fragility, increase optionality, keep buffers, avoid over-leverage when uncertainty is rising. That doesn't mean hide in a bunker. It means recognizing that big macro shocks often arrive through the price system first, and the price system speaks loudly through energy. If you take nothing else from this, take this. Negotiations with Iran are not just a diplomatic storyline. They're an expectations engine plugged into oil, plugged into inflation psychology, plugged into interest rates, plugged into the cost of credit, and plugged into consumer sentiment. And in 2026, when the economy is already sensitive, that engine can either smooth the road or shake the vehicle, sometimes both in the same month. The next time you see a headline about US-Iran talks, don't ask only, who's winning? Ask the question that actually predicts economic turbulence. Is the world becoming more certain or more uncertain? Because certainty lowers premiums, lowers volatility, and stabilizes planning. Uncertainty raises premiums, raises volatility, and turns normal life into a more expensive guessing game. And if 2026 teaches the United States anything, it may be this: the strongest economies aren't the ones that never get hit by shocks. They're the ones built to absorb shocks without losing their balance. Your job? as a citizen, as a worker, as a household, is to build the same kind of resilience on your own scale, so that when geopolitics shakes the system, it doesn't shake you apart. Sources used for grounding and context: Reuters reporting on oil moves linked to Iran talks and OPEC Plus decisions. Financial Times reporting on the state of US-Iran nuclear-related negotiations and regional mediation efforts. IMF commentary on how disruptions tied to Iran or regional oil flows can raise oil prices in adverse scenarios. Federal Reserve research on oil price shocks and their macro effects on inflation and output. U.S. State Department release on sanctions actions related to Iranian petroleum trading networks. Risk analysis on Hormuz-linked shipping and conflict scenarios and implications for oil infrastructure and transit routes.